Everybody loves to talk about stocks. The winners, the crashes, the overnight fortunes. Almost nobody wants to talk about bonds. They sound boring, a little complicated, like something only your grandparents owned. But here's the twist. That quiet, boring half of a portfolio might be the exact thing that keeps you calm when everything else is on fire. So let's fix the most misunderstood corner of investing. In plain English, this is Calm Dollar, where we take the intimidating parts of money and make them calm and clear. And few things get skipped over more than bonds. If steady, plain English money thinking is your kind of thing, consider subscribing, and let's give the quiet half of investing the 10 minutes it actually deserves. Because once bonds finally click, the whole idea of building a portfolio starts to make sense. Here's where most people begin. You open your first investing account, you buy a stock fund, and you feel great about it, right up until the market drops 20 or 30%, and your stomach drops right along with it. When you own nothing but stocks, every single downturn hits you at full force. And that is exactly when ordinary people panic and sell at the worst possible moment. What's missing from that portfolio isn't a smarter stock pick. It's ballast. Something heavy and steady in the boat that doesn't lurch every time the water gets rough. So let's define the thing simply. When you buy a stock, you own a tiny slice of a company. When you buy a bond, you do something completely different. You lend money. A bond is just a loan. You hand your money to a borrower, usually a government or a large company, and in return, they make you a promise. They promise to pay you interest on a set schedule and to hand your original money back on a set date. That is the whole deal. A stock makes you an owner. A bond makes you a lender. And when trouble hits, a lender gets paid before an owner ever does. Let's put some real numbers on it. Say you buy a bond for $1,000 with what's called a 4% coupon and a 10-year term. That 4% is simply your interest rate. So every single year, that bond pays you $40, like clockwork, whether the market is euphoric or terrified. 10 years of $40 is $400 of interest along the way. And then, on the maturity date, you get your original $1,000 handed right back. You knew the entire deal the day you bought it. That predictability is the whole point. Stocks whisper, maybe. A quality bond hands you a schedule. Now here's why that quiet little promise becomes so powerful inside a portfolio. Stocks and high-quality bonds often move differently, especially when markets get frightening. When investors panic and flee out of stocks, they very often run towards safe bonds instead, and that rush can push bond values up at exactly the moment your stocks are down. Look at 2008. In that crash, U.S. stocks fell by around 37% in a single brutal year. But high-quality U.S. bonds, that very same year, actually rose a little. So a portfolio holding both didn't fall nearly as hard as an all-stock one. And that calm half handed its owner something priceless: the ability to hold on, instead of selling everything at the very bottom. That, right there, is the real job of bonds. Not to make you rich, but to keep you steady enough to let your stocks do the enriching. If the boring half is finally starting to make sense, subscribe so the next one finds you. Because there's one catch about bonds that almost nobody explains well, and it trips up nearly every beginner. So let's clear it up right now. Bonds are far calmer than stocks, but they are not risk-free. And here's the main way they actually move. Bond prices and interest rates behave like two ends of a seesaw. When one goes up, the other goes down. Picture that bond of yours paying 4%, $40 a year. Now imagine brand new bonds start getting issued at 5%, $50 a year. Suddenly nobody wants to buy your 4% bond at full price, when they could just grab a fresh one paying 5. So if you needed to sell yours early, you'd have to mark the price down a little to make it competitive. That is why bond values can dip when interest rates rise. And the flip side is just as true. If new rates fall to 3%, your 4% bond becomes the popular one, and it's suddenly worth more than you paid. There are a couple of other risks worth naming plainly, no scary jargon. First, inflation, which quietly eats away the buying power of those fixed payments over the years. And second, default risk, the chance a borrower simply can't pay you back at all. That's why a bond from a stable government is treated as far safer than a bond from a shaky company. And it's why the shaky company has to dangle a higher interest rate to tempt anyone in. That is the rule sitting underneath all of it. The safer the borrower, the lower the interest. A higher yield always means higher risk. There's no free lunch hiding in there. You don't need to memorize a whole catalog, but a quick map helps. Bonds mostly come in two flavors. Government bonds, where you're lending to a country, and that's generally the safest end of the pool. And corporate bonds, where you're lending to companies which pay you more precisely because they carry more risk. Bonds also come in different lengths. Short-term bonds are steadier, but they pay less. Long-term bonds pay more, but their prices swing harder whenever interest rates move. Now, you do not have to sort through all of these one at a time, and that leads straight to the single most useful move a beginner can make. Here it is. For most regular people, buying individual bonds one by one is more trouble than it's ever worth. The far simpler path is a single low-cost bond index fund. Instead of hunting down one bond, you own a tiny sliver of thousands of them all at once, government and corporate, short and long, all bundled together in one holding. That is instant diversification from a single purchase. So if any one borrower stumbles, it's a harmless rounding error, not a real wound. You get the calm, steadying ballast of bonds without ever having to become a bond expert yourself. The last question is how much to actually hold. And there's no perfect number here, only a sensible range. The classic starting point is your stock-to-bond mix. Are you young, with decades still ahead of you? You might lean heavily into stocks and keep only a thin slice in bonds because you have time to ride crashes all the way back out. Are you closer to actually needing the money? In your 50s or 60s? Bonds usually grow into a much bigger share because protecting what you've already built starts to matter more than chasing the last bit of growth. One old rough guide said to simply hold your age in bonds. It's blunt, and longer lifespans have softened it. But the instinct behind it is right. The closer you are to spending the money, the more ballast you want in the boat. And whenever the math starts to feel fuzzy, fall back on the sleep test. If a normal market drop would leave you lying awake at night, you probably want a little more in bonds. If a drop honestly wouldn't faze you, and you're still decades out, you can likely afford to hold less. There's no medal waiting at the end for suffering through volatility you never needed to take on. And one last small habit makes the whole thing actually work. Rebalancing. Just once a year, nudge your mix back to your target. In practice, that quietly forces you to trim a little from whatever soared and add to whatever lagged. You end up buying low and selling high almost on autopilot, which is the very thing that calm half is there to let you keep doing. So let's bring it home. A bond is simply a loan you make in exchange for steady interest along the way and your money back on a set date. Its job inside your portfolio was never to make you rich. It's to be the ballast that stops you from panic selling the part that actually will. Remember the seesaw with interest rates. Respect that a higher yield always means higher risk. Keep the whole thing simple with a low-cost bond fund. And size your slice to how close you are to needing the cash and to how well you sleep at night. Do all of that, and the boring half of investing quietly becomes the very reason you can stay in the game long enough to win it. If this finally made bonds click, that's the whole point of Calm Dollar. So tap subscribe before you go. Next time, we dig into a hidden retirement danger that even careful savers walk right into, called sequence of returns risk, and why the order of your good years and bad years can matter just as much as the average. And the reminder that always matters most. This is general education, not financial advice. The numbers here are round examples chosen to show how bonds work. And real rates, real returns, and the right mix for you will differ and shift over time. So run your own research, or talk to a professional you trust. Keep it calm and keep it yours.